Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, September 30th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to start off by showing you just how ugly it was this week. Now, this particular chart is just for today, Friday, September 30th. This is a 1 minute one-day chart. So each candlestick on this chart does represent 1 minute of trading on the S&P 500. And what we can see here is, and by the way, the dotted blue line is where the market would have closed on Thursday. Okay, so we opened up slightly low, and then you can see we worked our way up, and we were actually positive for a couple hours here during the morning trading. But we peaked about 11:15, as we can see here, and started to sell off. Went negative just after noon, and then poked our head above this this line here, this dotted blue line, which again is where we closed on Thursday. And then we can see as the afternoon wore on, the market just fell and fell. And look at this. We closed right at the lows of the day. The lows of the day, and it's kind of tiny type, but it's over here in the upper right when my cursor is circling. The low of the day, 35.8413, which, by the way, is now the new low for the year, for this downturn. And so 35.8413 is that new low, but we closed at 35.8647. So just on Friday alone, down 1.48%. But the fact that we closed so low, again, 34.8513 was the low, closed 35.8647. So basically, within just a couple of points of the new low, guys, that's not that's probably not a good thing going into Monday. All right, so this is just today's trading, just on Friday, the 30th. Now let's go to a 10-day. So this is the last 2 weeks, last 10 days of trading, and this is a 10-minute candlestick chart of the S&P 500. And we can see here, and I'm going to pull up the annotation tool just to make this easier. Let me get a horizontal line here. And what I want to do is I want to draw a line right around 3,800. That should get us close enough, about right there. A couple of weeks ago, right, things weren't looking too bad. We were trading above 3,800. But what we can see here is on the 21st, right at the tail end of the day, we sold off and closed below 3,800. And since we broke below 3,800 here, we've just been falling and falling and falling. And we can see this 3,600 level, which up to this point, we haven't had any trading below 3,600 for quite a while, guys. And I'm going to show you how low we are relative on a time span here on a longer chart, so bear with me. And by the way, before I forget, I want to pepper this out there. If you are a Simple Market Signal subscriber, I've got a very, very special chart for you guys this week, as I do every week. But this particular one, some really interesting information I'm going to share with you. So if you are a Simple Market Signal subscriber, either on the email version or the video version, remember you have two ways you can access it. They're two separate products, so you don't get both. You have one or the other. But if you like email, then you've got the email option. If you like video, you've got the video only option. Each one of those options is still less than $20 a month, and even with inflation, I haven't raised my prices. still the same price as it was in 2019. So probably not the best idea for me, right? My costs are going up, but I'm keeping my cost to my subscribers the same. But guys, I've got a very, very special chart for you. And of course, a lot of great information as always. And as a lot of you know, a lot of you are down a fraction of what the overall market is down this year by following the Simple Market Signals proprietary model. So I'm glad you're with me, and I know the model. Again, I created it for myself, and my accounts are down very little this year. especially relative to the overall stock market, and it's due to the model. It just makes it so much easier to understand what's going on and knowing when to step aside and let the market fall and not take part in it. So if you're not a Simple Market Signal subscriber, I'll tee up some more information at the end of the video. Guys, it's extremely cost effective, and it really helps. And it's not an expense; it's an investment. All right, it'll help you make money, and it'll help you lose as little as possible in markets like this. But with that said, let's move on with the charts and look at this, man. We are now trading underneath 3,600 on the S&P 500, and it's the last. Remember, these are 10-minute candles, right? So in the lower right-hand corner where my cursor is circling, it's the last 10 minutes of trading on Friday the 30th that, and basically the last 10 minutes of the quarter, okay? But the last 10 minutes of the first 9 months of the year, we look at it so many different ways. But look at that. It was the last 10 minutes of trading that took us below this 3,600 level for the first time this entire year, all right? And is really just the last 2 days that undercut the lows that we had set back on the 17th of June, the intraday low. So we're now trading at the lowest point year to date of this downturn, and it's it looks like it's going to get worse, guys, before it gets better. All right, nobody can predict the future, but the setup is not good. But what we're looking at here is the sectors for the S&P 500 for this week, all right? And energy was positive, right? Everything was negative a week ago, but energy at least was positive this week, up 2.28%. But you can see the other 10 sectors of the S&P 500. Remember, there's 11 sectors in the S&P 500. The other 10 sectors were negative for the week. And, for any of you guys that think, yeah, but I'm in bonds. Bonds are safe. Well, let's take a look at that. All right. This is a 1 week return for different bonds. And you can see things like the TLT, the 20-year plus ETF, right? These are government bonds. These are supposed to be quote unquote safe. Just this week alone, down 3.06%. And you can see you lost money, whether it's low-quality junk bonds, aggregate bonds, the LQD, which is an investment-grade corporate, shorter duration, 3 to 7 year treasuries, 7 to 10 year treasuries. Everything was down this week. And if we go back year-to-date, guys, look at the returns on these bonds, all right? And the return on these bonds, like the TLT, in some cases, it's down more than a lot of the equities, right? And same with the LQD, depending on what you're looking at. These things have lost as much or almost as much as a lot of the equity ETFs out there. All right, so nothing is working right now, and this is not a time to be a hero. All right, if it's up to you how you trade and invest, but if you want to be a prudent money manager, understanding when to step aside and let the market fall and not try to be a hero and not try to catch a falling knife is one thing you should clearly think about, right? Because this market is dangerous, and it's starting to look. And I think I started this thought and didn't finish it, so I apologize. But this market is starting to look and feel a lot like the 2003 downturn, where every time it felt like we were starting to get some traction, starting to pull out, something else would happen and it would send us lower. All right. Now you can get counter trend rallies, and a lot of counter trend rallies in that type of a market. And I would not be surprised with the way the market has fallen over the last few weeks. I wouldn't be surprised to see a counter trend rally sometime in the next week or two, right? That might bring us back up, but with the backdrop and the way the setup is, guys, it's unlikely that it's possible, but unlikely that we have seen the lows of this downturn. All right, so the S&P 500 was down 2.91% this week, and by the way, now we're looking at a weekly candlestick chart of the S&P 500 that goes back 3 years. Okay, so 3-year chart. Each candlestick represents 1 week of trading, so we can see before the COVID downturn, and of course here is where we're at over on the right where my cursor is circling. So the S&P 500 fell another 2.91% this week. We closed at 3585.62. So that is a new closing low for the year. And of course, you can see right here, calendar year 2022, you can see we're clearly trading at the lows of the year. But not only are we at the lows of the year, we have to go clear back to the tail end, the last couple of months of 2020, guys. I'm going to go ahead and start marking this up here as I'm talking and walking you through some of the annotations I've already put in there. But I'm just going to put this line around 3,600, and we can clearly see. There we go. And we can clearly see here that the last time the S&P 500 traded below 3,600 was back in November of 2020. All right. So we have erased all of the 2021 gains, and we're now back to levels we have not seen on the S&P 500 since November of 2020. All right. And I would not be surprised, right? I think we're going to go down to at least 3,500, because if you look here, the next real level of support starts at around 3,500, as we see here. All right, and just click back out of that and save my work. Come on, computer. There we go. Computer lag there for a second. Sorry about that. But you can see here where I drew this line at 3,500. That is the top end of the range. So, and we're obviously very close to that. We just need to fall another 85, 86 points, and we're down there anyway. But that would get us down to 3,500. And then the next thing we need to look at is the pre-COVID peak, which was right there. I'm just going to put a little circle around that. And that takes us down to around 3,400 on the S&P 500, 34, 3350, right in that window there. All right, and it's pretty common, and I've been at this, guys, for decades. All right, and I've seen this on individual stocks. I've seen it on baskets of stocks, ETFs, whatever, indexes. It's very common when you're getting a bad pullback like this, and of course now we're in a bear market, right? But it pulls us down. It's very common for the market to, or whatever you're looking at, the individual stock or whatever it is, to pull back to the peak of the previous high before you had a downturn. All right. So in other words, we ran up. We got just under 3,400 on the S&P 500 before the COVID downturn. We had the COVID downturn, of course, all the stimulus that brought us back very quickly. Otherwise, of course, without the government printing all the money, all the stimulus and all that, we would have been lower for longer. But that brought us up here. And then we had this trading right around the 3,500, kept knocking our head at around 3,500, and that created that what is now a support level, right, which hopefully will hold. But that was that overhead resistance right here that I'm looking at in moving my cursor around, and that was back, of course, in August, September, October of 2020, that 3,500 level. And then once we broke out of that, right, in November of 2020, then of course we were able to move on and had a pretty nice steady uptrend until we peaked right here in January of this year. And of course we've been falling with those counter trend rallies. Of course, this one, of course, was a really nice one, lasted a couple months. But now, right, we're below 3,600 for the first time in this downturn, and below 3,600 for the first time since November of 2020. All right. So, this is getting really, really serious here. And so now 3,500, maybe 3,350 to 3,400, that previous peak. And then the lower band, the lower end of this band is going to lay right here at this 3,200 level. All right. And so you save that for you here. All right. So you can see there was quite a bit of trading starting in the latter part of 2019, right here in December of 2019. And of course, after we, for the first couple months of 2020. And then once the stimulus kicked in, and then we traded right up to this 3,200 level again. You can see it acted as overhead resistance for a short period of time in the summer of 2020. And then once we got above that, right, we have not traded below 3,200 since July of 2020. All right. And you can see we, ping-ponged back and forth between 3,500, 3,200, 3,500, got close to the 3,200 again, and then finally made our way up. So this area here, 3,200 to 3,500, represents the strongest support level below where we are currently trading. All right. Now, I am not saying that it can't get worse than this. It can get a lot worse than this, okay? We may, if this is a really serious bear market, guys, we may be down half of what we're going to go down, all right? I am not making that prediction, and I'm never going to use the word crash because it's a stupid word that it just evokes emotion and doesn't help us, all right? Let's be more mature. more scientific, more mathematical, more exact, and more cranial than that. All right, let's not rely on emotion and oh my God, the sky's falling. This is getting bad, no doubt about it, guys. This is not a good scenario. All right, and again, my model for those people that were paying attention, could have had us and had me out in January. All right. I'm glad to share the information with you. You just have to subscribe and spend $20 a month, and you get access to my information. All right. But for those people that are still writing this down, in the S&P 500, again, down 291 this week, the S&P 500, of course, on January 4th of this year, peaked at 48,1862. We closed at 35,8562 this week. So the S&P 500 now, as of September 30th, is down 1,233 points, or 25.59% from the all-time intraday high back on January 4th. All right. So from right here to right here, we're now down 25.59%. And of course, anything below 20%, when you're down more than 20%, you're in a bear market. So, we've only had a few weeks. This is the fourth week now where we've technically closed in a bear market. Again, let's be technical, right? If we're going to be technicians, if we're going to be chartists, we have to be exact. We have to be accurate. We have to be able to quantify our work. All right. So, please, guys, be careful with these people out there in these videos, crash, 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 crash. If you can't quantify it, if it's just emotional, please don't fall victim to that. All right. I'm telling you that it can get a lot worse. All right. But I don't know. I can't predict the future. All we can do is look at, an if this, then that scenario. But again, we've been down 3 weeks in a row. We're down quite a bit. I mean, 3 weeks ago, we were trading at 4,100, right? Now we're below 3,600, made a new low for the year, new low for the last couple of years, new low for the downturn, new low for the bear market. And we've now put in what is a technical double bottom on the S&P 500. So, it's possible, right? We had the lows on June 14th, and now we have this new low here on September 30th. So, of course, these are weekly candles, but you know that those were the 2 dates, right? So we now have this double bottom where we have undercut the previous low, and we've knocked out any stops that were set maybe at 3,600. All right, so it's possible that over the next couple of weeks, perhaps we can get a counter trend rally and get a little bit of a relief rally here. But I still think that I would be quite surprised if we don't find ourselves down to at least 3,500, if not 3,350 plus or minus. All right, which of course 3,350 is just below the pre-COVID peak of the market here. As a matter of fact, let me hit the price label and let's see if we can get a number. 3393.52. Okay, so again, like I said, 3350 to 3,400. That would get us down to that pre-COVID peak. And again, I've seen this time and time again, guys, on the charts where when you're getting a sell-off like this, whatever investment you're looking at, in this case the S&P 500, is very common for it to pull back to the top end of the previous range, and that again would be just under 3,400 at 3393.52 was the peak before the COVID downturn. All right, so these become 3,350 plus or minus 150 points. That puts us in this big band. We traded in that window, right, from 3,200 to 3,500. We had trading in that window from the latter part of 2019 until the latter part of 2020. So, we had almost a year, right, where we had at least some trading, quite a bit of trading in that window. So I really think for a lot of reasons, this is the target area. Maybe we'll get lucky and maybe that won't happen. But I think at this point, from a technical standpoint, it's, we're probably looking at that 3,350 plus or minus area at least, and based on some of the things that are out there, guys, we should probably count ourselves lucky if it doesn't get any worse than that. So I'm not trying to be negative. I'm just being realistic. Okay, and remember, guys, bonds are not getting it done. Every sector of the S&P. I mean, let's just go back year to date here. And you've got energy is the only sector year to date that's positive, up 34%. And whenever you see the energy sector being the only sector that's positive, that is generally not a good thing. It's generally not a good thing for the economy. It's generally not a good thing for our pocketbooks. It's generally not a good thing for inflation. And it's generally not a good thing for the overall stock market. Okay. Anyway, you can see how bad all of these things are. Now, even if you predominantly just trade and invest in the S&P 500, it is still important, in my opinion, for you to understand what's going on underneath the surface, right? What's going on with these different 11 sectors. It makes you a better investor and trader. Even if you're an individual stock trader, you need to understand what's going on at the sector level, which is why I do this work, which is why I'm sharing this stuff with you, okay? And then, of course, the bonds, guys. This is, one of the worst years in bonds in a long time. And I'm predominantly an equity guy, but again, you need to understand what's going on at the bond level, because it makes you a better investor and trader. All right. But definitely, Friday, right, kind of tells the whole story. And we closed at that new low on Friday, and you can see over the last 10 days what has happened. But, this is getting ugly, and we might over the next couple of weeks get a counter trend rally, a little bit of a relief rally. It's possible that we're going to hit, that we've hit a double bottom here. We'll just have to see what next week's trading brings. But remember that, September and October can be pretty rough months for the stock market. And September obviously lived up to its reputation with, the last 3 weeks being negative. But I would be at least prepared for further downside. And we need to hope that 3,200 to 3,500, somewhere in this window, in other words, 3,350 plus or minus 150 points. We need to keep our fingers crossed that holds. And guys, for your own benefit, stay with the balance of this video. I've got a lot of really important information to share with you. Do you manage any of your own money, including in your 401k or IRA? Do you have exposure to the S&P 500 or other large cap U.S. equities? Are time and money important to you? If time and money are important to you, then simple market signals should be important to you as well. Simple market signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need simple market signals. Simple market signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple market signals is equity investing information simplified. Simple market signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime. And a subscription to this information is less than 67 cents per day. And it's priced way less than it should be for the value it brings. I developed simple market signals for myself. I am now making my proprietary model signals available to you. The simple market signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits, and this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market, and the market is generally sideways to slightly up or down. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green, yellow, green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018 and what you'll see also in 2020 is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03. And then next we'll take a look at the bear market that started in 2007, that ended in 09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. And this risk signal, the market mode signal, would have been red through the majority of this downturn, and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower, all right? And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased. Now let's take a look at the bear market from 07 that ended in 09, and you can see here that the risk signal would have turned red right here, right around 1500 on the S&P 500. And you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week, and then the market rolled back over. And so maybe you would have had a small loss here. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. The potential benefits, if used properly, include increased upside capture, decreased downside capture, improved risk-return profile, and the ability to sidestep major market downturns. Simple Market Signals is stock market-based, rules-based, and based on our proprietary multi-factor model. Simple Market Signals does not include opinions, hunches, guesswork, or conspiracy theory. We stick to market-based facts. Who is Simple Market Signals for? It's for equity investors. Simple Market Signals is perfect for individual investors, whether you're novice or experienced, as well as financial industry professionals. And it's right for anybody that wants to employ both offense and defense with respect to their investments. And it's for anybody that wants an edge, wants an advantage when it comes to their investing and trading. Simple Market Signals works with any type of equity account, including 401ks, 403bs, IRAs, or any other equity-based retirement plan like a SEP, a Simple, or whatever you may have at work. And Simple Market Signals is, of course, perfect for non-retirement accounts like a margin account or a trading account, or however you refer to your non-qualified, your taxable trading account. Simple Market Signals works with any type of investment vehicle, including mutual funds, ETFs, stocks, or options. Who is this available to? Any adult who has access to YouTube around the world. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course, the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. We're going to cover pretty much everything in there. So this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material. And this will be anything additional when applicable. You will also have access to best practice videos for the successful implementation of everything related to Simple Market Signals. So the market mode, the risk signals, you'll have educational videos on that. You'll have educational videos around the general trend indicator to help you fully understand how to use them and what are the options that you may want to employ. The signals are updated each weekend in our weekly video newsletter. The weekly video newsletter is generally ready by Saturday at 6 p.m. Eastern Standard Time each week. However, depending on our production schedule, the weekly video newsletter could be finished and ready for you to view anytime over the weekend, right? If we can get it out earlier, we will. And if there are any major signal changes in the middle of the week, we're not going to wait until the weekend to get you that information. We will post a new video mid-week with the new updated information. If there are any major signal changes to either the risk signal for the overall market or to the general trend indicator. Now, if a signal changes on one of the sectors, we do not post a midweek update on that, all right? We reserve the midweek updates for the major signals, and then each weekend, of course, you will get the updates on the sectors as well as all other information. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button. You want to add your credit card information. So as you can see here, you can pay with either a credit or debit card, enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. And once your membership is established, you will be able to go under the membership area of the channel, and you'll be able to scroll down and see all of the videos. And you'll be able to go down and watch any video from the past. You'll have all of the old video newsletters as well as all of the charts and market analysis videos. So everything will be here, the training videos, everything. You just keep scrolling down and you're going to find all kinds of information. And then all you would have to do is just click on one of the videos here, and it'll pull that video up and you'll be able to watch it from there. Okay, so it's just that easy to access the information. So I'm going to back out of that, and everything is right here under the membership area of the channel. Now, from time to time, YouTube does change things, and of course I can't, as a creator, I can't control that, so you may want to also double check the community tab from time to time, but everything should be under the membership area of the channel. And that's all it takes to become a member, guys. It's quite easy. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate, but there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signals. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. So join now to start benefiting immediately from this valuable and potentially life-changing information.